Good afternoon, everybody. Thank you for joining us. My name is Dale Jannels. I'm one of the directors of Impact Specialist Finance and delighted to have with me Steve Cox, who is Distribution Director from Fleet Mortgages. Hi, Steve.
Hi, Dale. Thanks for the invite.
No problem. Thanks for your time. Great to have a lot of people with us today on the webinar. So what we're going to do is Steve's going to go through some of the buy-to-let areas that they cover, the market covers, and also to do with fleet. I've got some questions that have already been sent through from some of the audience. If you want to send a question through, please just email me or do the chat function and I will ask Steve that question. But in the meantime, for the next 15 minutes or so, I'll pass over to Steve to share screens and go from there.
What I want to do is just take a look as to where do we think the buy-to-let market will go as an influence of the COVID environment that we're living in. Unfortunately, my crystal ball is broken, but there seem to be some very strong indicators as to where we think it'll go, and that's actually based on a bit of history. So we're going to go back to some history, if I can get the next slide to work. There we are. So we won't go through what fleets are at the moment. So our firm belief is that buy-to-let is actually a counter-cyclical part of the market, and there are some fundamental principles here that seem to be very true today, just as they were back with other recessions we've been through, and of course the big crash that a lot of us lived through 2008. In times of uncertainty, consumers are basically just less likely to make long-term financial commitments, and of course that will also involve moving house and committing to bigger mortgages. Perhaps the paradox that we're seeing at the moment is everybody is very, very busy, not just at Fleet in buy-to-let, but the market as a whole is extremely buoyant. Are we riding a wave? It's difficult to tell. I'd certainly say my view would be, in residential terms, SDLT is having a big impact on the volumes that you guys are all seeing in the market presently. To a degree as well, that is fueling buy-to-let. But I'll investigate that a bit further. It may not just be SDLT that's seeing volumes climbing buy-to-let as well. So when things are bad, history does teach us that tenancy demand rises. So what we're trying to investigate here is, given the COVID situation we're all living through right now, do we actually think that tenancy demand will continue to rise, both in the present and the future? So we go back to 2008, there are some parallels. There's also some differences as well. So governments globally in 2008 launched a lot of economic stimulus packages, just as we've seen today, with Rishi's very generous packages that keep coming and coming. Of course, we're all going to have to pay that back at some point, but there's clear parallels there where governments have stepped in to try and prop up the economic future of the UK. What we've also seen, which is different to 2008, is the emergence of things we didn't really pay much attention to until March. So furlough, for me at least until March, was something to do with the racecourse at Sandown and by how many furloughs the horse won by. But it's a word we all know. Zoom, Microsoft Teams, everything else to do with that. It's just quickly emerged kind of out of nowhere. But fundamentally, what governments have tried to do is to step into this crisis we're all living through to prop up the economy. So what actually happened back then? Well, taking you back to 2007, the average UK property price was 190,000 in September 07. The availability of credit, or the lack of availability of credit, to be more accurate, just drove down the average price. So by March 2009, that had fallen to 154,000. The clear things that drove down the average house prices then was lack of credit and rising unemployment. So what we don't have right now is lack of credit, although in residential markets, of course, what we do have is lack of consistency in high LTV lending. We unfortunately do have rising unemployment, which may well continue to rise, particularly as furlough runs out at the end of this month, and we'll see what positive impact the Chancellor's replacement scheme will have on preserving jobs. But what that will do, that combination always says, well, it may well stifle owner-occupied demand. So it's a 7-year cycle. So the average UK property price didn't recover back to 2007 levels for 7 years. So are we actually on the cusp of another cycle that might look the same as that? What happened to private rental sector and buy-to-let in that period was there was a very, very, very steep rise in tenancy. So we went from 2.69 million households in private rental sector in 2007. That climbed extremely steeply to 4.38 million households in 2014. And if we look at it and say, okay, what do we think is going to happen to private rental sector during this period? So this is separate to the current bubble we're living in for first for residential owner occupied stuff, particularly with the SDLT incentive. It could well be the case that we're going to see demand for tenancy rise again. Certainly what we're seeing at the moment and in recent weeks and months is landlords are extremely positive about future demand for tenancy. We're seeing a lot of landlords begin to gear up portfolios at the moment to release cash, presumably to either buy now. If a deal works on yield now, they're going ahead with that. Purchase has risen as well, but potentially to stockpile cash to buy at the right time. The right time for everybody is, of course, near the bottom, but of course it's always virtually impossible to predict where the bottom will be, and indeed whether house prices will fall when we get to the end of the bubble and end of SDLT. My personal view is there might be a correction. I don't see anything like a catastrophic fall coming into play. So we can circulate all these slides for you. All that does is just underlie the reduction in the house price, how long it took to recover, and the top line is how steeply demand or households going into PRS climbed in that period. So there were primarily back in 08, three main reasons. It was all triggered, of course, by the US subprime mortgage crisis. It just kicked in a global recession. The unfortunate news is we are in a global recession. There's no question about that. It knocked consumer confidence, generally speaking. We may well see that happen. As I say, the paradox to this at the moment is the volumes we're seeing in the market. Is that artificial, fueled by SDLT? We will see. But generally speaking, consumer confidence will always be down in a recession. And as a result of that, people are less likely to commit long term. So all the government stimulus packages are there to keep confidence high. Is it artificial? Will that run out? Who knows? It depends on how long this COVID environment lasts. It depends on what happens to unemployment as the support schemes run out or change. But ultimately, in times of trouble, people do end up in the private rental sector generally. And a lot of the reason for that is in the UK, we don't really have much for social housing policy left. Being brutal about it, people have got to live somewhere. And generally, they're going to end up in the private rental sector. So what happened back in 08 is to boost availability of credit. The banks flooded the system with liquidity. Credit availability then helped the UK housing market recover back from its low in March 2009. But what it also did is the availability of credit kicked buy-to-let lending to another gear. So although the main reasons for credit being flooded into the markets, not just in the UK, but everywhere else as well, was to stimulate the housing market period for residential owner-occupier, a byproduct of that was more availability of buy-to-let credit, actually then just boosted the number of properties that were falling into the PRS, and landlords saw it as an opportunity. So we look at where are we at today versus back then. Well, if we were doing this conversation in May or June, in the aftermath of lockdown, credit dried up. Didn't dry up entirely, but certainly in the markets that we operate in, and a lot of the markets a lot of specialist lenders operate in, the securitized markets effectively shut down overnight. So liquidity suddenly pretty much vanished, not just for Fleet, but for a lot of specialist lenders as well that also fund through those markets. And the icing on the cake that killed that wasn't just uncertainty, it was the lack of valuers going out there to do physical valuations. Now, if you then fast forward probably 2 months after that, well, valuers were let out, the market reopened, and so did the securitized markets pretty much overnight. So when we talk to the funders that we work with and those that operate in the capital markets periods, there is still an underlying confidence in the UK housing market surviving and thriving even in a COVID environment, and particularly buy-to-let. It's something that the funders are aligned with, as what we're seeing with the landlords at the moment, in that in times of crisis that we're in at the moment, it does seem still likely that the demand for tenancy is going to go up. So that is a very, very positive thing. If there's no money to lend, it doesn't help me, it doesn't help you guys, it doesn't help Impact. In the summer, it was looking pretty grim, being honest. But just as fast as it became very grim, it suddenly became very, very positive again. So let's hope that continues. Low interest rate environment always helps the situation. We're even now looking at the possibility of negative interest rates, which until these days was probably just a concept in theory. It may well become the reality. With low interest rates, investors still see bricks and mortar as offering a better return than anything else that's out there. So if you couple that up with a potentially rising demand for tenancy, is it the perfect storm? And are we seeing landlords capitalise on the unfortunate byproduct of an economic downturn caused by COVID? So where are we right now? Well, yeah, there is a global recession. That's obvious to everybody. Having said that, the mortgage market is buoyant, very, very buoyant for all of us, not just in our sector, but across the board. And that's been driven because there is still an ample supply of credit. Interest rates are more or less zero anyway, and that's probably going to stay the same for some time to come, if not years. I do think, unfortunately, it's inevitable there are going to be rises in unemployment. So we've seen the news this morning over in Northern Ireland, where they've gone into a temporary, more or less full lockdown. There's obviously sectors of the economy, be that travel, tourism, hospitality, they are really struggling, and retail on the high street as well. So the sad situation is, it does seem inevitable that unemployment is going to continue to rise. And we go back to the point that I made earlier, people have got to live somewhere. So where are they going to end up? They're probably going to end up in the PRS. Stamp duty holiday, it's fueling the market, but I'm not so convinced it's fueling the rises that we're seeing in buy-to-let. It certainly is to a degree, in that it is a reduction in costs for a landlord. But landlords are running this as a business. So I actually think all the other indicators pointing towards a rise in tenancy demand is fueling the market as opposed to the stamp duty holiday per se. So being positive and optimistic, I would hope, and I'll predict, I'll put my neck on the line in that after the stamp duty holiday finishes, but the volumes may go down a bit, but I think buy-to-let will sustain beyond there. So what we are seeing as well is obviously the landlord type has changed. We've got less people that are archetypal dinner party landlord. We've got more semi-professional people, portfolio landlords, people who run it as their main business. But landlords are changing in what they do to that portfolio of properties, whether it's 2, 3, 4 properties or 20 plus or whatever. We're seeing this more and more. So people are taking advantage of the potential tax gains in putting portfolios into limited company. We're seeing that rise. We're also seeing landlords diversify where their portfolios are. So more and more common would be where a landlord may have quite a bit of property in London South East, where they've been enjoying capital growth for years and years and years. Landlords are now beginning to diversify that portfolio away from London South East to gain yield further afield, be that in the Midlands, in the North, in university towns or wherever. The yields are better out of London. So landlords are trying to balance their portfolios to strike the right position for them, where you've got potential capital growth, but also a good yield to keep the whole portfolio running and wiping its own feet. What that leads to really is the other big growth area we're seeing, which is a rise in demand for HMOs and multi-unit blocks. And that makes sense because it just provides better yield for landlords right the way through. And if you couple that with them coming out of London South East as well, I think that will continue to grow. So the only bit I'm going to sell on fleet before I stop sharing, and then we go back to Dale with some questions, is I know SLAs and turnaround times and all that kind of stuff is a very, very hot topic. It makes your life difficult if things just disappear into a black hole. I will be honest and say I don't quite know how we've managed to do it, but even as of today, we've still got SLAs in 24 hours. At times it does pop out and we end up in 48 hours, but we haven't slipped past that. So one of the things we are hell-bent on preserving are those SLAs, because we know without quick turnarounds from your point of view, it leaves you as advisors in a very difficult position with customers, and doesn't move it all further forwards. So I'm not going to sell fleet any more than that, other than if you want a quick answer, come to fleet.
Thank you, Steve. That was brilliant, as always. Thank you. So availability of funding is brilliant news for everybody in the marketplace, obviously compared to the last recession, etc. Delays you've mentioned across the market, absolutely. Our biggest problem and our biggest scare, I think, or worry, is obviously the valuers can't get out to properties and so on. But we're seeing already some huge delays with regards to valuers making an appointment and then taking a further amount of time to actually get out to the property. Is that something that's coming down your line, or is that just lender specific? What's the general consensus at the moment?
It is an emerging issue, particularly in the last few weeks. So with the surveyors, of course, there is only a finite capacity in the market. We're seeing very, very high volumes across all areas, not just specialist lending. And that does cause an issue. The bit that is probably emerging as a bigger concern, it's not actually the turnaround time period. Because I think everybody accepts, customers alike, carrying out physical valuations in a COVID environment, it does take longer, it's more hassle. More safety procedures have to be put into place.
Of course.
Down. Everyone accepts that. The bit that is of a concern is the delay in the booking queue, and we're trying to address that, and I'll explain what I mean by that. So from the point of view of where you're putting a case in, without being valuer specific, it can be as long as a week after the case has gone in. The valuation has been instructed by Fleet or any other lender, but there is a queue just to make the call to then try and make the booking.
Sure.
Okay, so all that actually does is just elongate the turnaround times even more. From an advisor's point of view and the customer's point of view, it's almost like it's been approved, it's moving ahead, but it then disappears into a black hole, and that's not good news. So
Sure.
I think most people would be are accepting, even if the valuation is booked at a future date, if it's booked for a week or 10 days time, what that does is takes the heat out of the situation. In other words, you know it's going to be booked. There's only so much capacity. Yes, it isn't as quick as it would be in normal times, but the date is secure.
Yeah.
So what we've been doing is working with our panel managers to not just use the big in-house large surveying firms that we've all got access to. It's to use the wider panel to take the sting out of that booking delay.
Sure.
So smaller entities can still take jobs and make the call. Ultimately, they may not actually turn around the whole thing any quicker than the large ones would, but that's kind of not the point. If the job is booked, the job is booked, and everyone knows then what to work to. Us, like other lenders, we don't stop the work. We instruct the valuation first and carry on doing all the underwriting. So there are delays, but in a lot of cases now, as soon as the val's back, we go straight to offer.
So let's talk about local lockdown. So Liverpool at the moment are in total lockdown. Are valuers able to go out to properties in Liverpool, or are they going to have to delay it until it reopens and so
on? They are allowed to go out, and this will obviously vary firm to firm. Okay, so we're not in a situation that we were in March, where don't go out, don't do anything, don't go to work. What the challenge is, it's not even that. So that the surveyors are all following COVID safe processes and procedures in how do they book the appointment, windows open, everybody out, that kind of thing, access to the property. But when you go into local lockdown, the problem is occupiers, which could be existing tenants or whatever the situation is, or if it's a purchase, people are still living there, obviously. It's how do they feel about letting a surveyor
stranger in.
So I don't think we're quite through that bit yet. Inevitably, it will cause delays, but God bless the valuers. We need them to still be out there.
100%. 100%, and we totally understand what they've got to go through to get appointments booked and so on. Just before I come on to a couple of questions that we've been sent over live, do you think this is going to increase the north-south divide? And we're seeing personally, because obviously we're based in Horsham in West Sussex, we're seeing a lot of people moving out of the big cities like London and so on, and moving out a bit more into the suburbs and into the countryside. Is that something that Fleet are seeing?
As I say, I think what we're seeing is more and more landlords just diversify their portfolios further afield. And their driver is to balance yield and capital growth.
Yeah.
So I think actually we would certainly, or our experience would certainly suggest that it's less of a divide, because people that traditionally might have only run a portfolio in the suburbia of London are now far more open to diversifying and getting better yields, buying property further afield.
Yeah. Okay, that's cool. We've got a question from Tom. What is the maximum funding an individual can hold from Fleet? And also, off the top of your head, your ICR calculations, maybe for clients that might have fallen into higher tax rates last year.
Okay, so if we take the ICR calc, we are non-regulated, because we only operate in buy-to-let, so we don't fall under the PRA rules on calculation. The reality is a lot of business we do comes in on the pay rate products, which effectively what that means is, and we can share all that with you, Dale, and your guys, is it effectively means in most cases we can lend more than others that are under the different restraints of PRA.
Sure. Okay. And have you got a maximum funding on what an individual can hold with fleet?
Well, we are presently talking to funders about that. As I say, the funders are very, very positive. I will answer that and say within the next 24 hours or so, we will be upping exposure. Okay, so we looked at exposure of 5 mil. We may well be able to get that better.
Nice, you heard it here first, an exclusive. Purchase, remortgage, are you seeing an increase in the purchase side? It does seem to be something that's a mass rush with regards to impact. Everyone is coming to us is in a race to get the offer out. The estate agent has sold the property to 3 or 4 people. Whoever gets the mortgage offer out first wins, and so on. Are you seeing an increase in purchases, or are you seeing people remortgage to raise money to go and buy more properties?
What we've seen, I don't mind sharing the statistics and how it's changed. In that, before COVID, fleet has always operated roughly at 20% purchase, 80% remo. We have seen that shift, but it shifted out not as dramatic as some lenders are reporting. So we've seen that climb to 30% purchase, 70% remo. Okay. There is more purchase business out there, but it's kind of in kilter with the increase seen on remo as well. So, talking to some of the landlords directly as we do, not because we actually do the back book servicing ourselves in a separate department, what landlords are saying to us is, look, SDLT is all very nice, and a lot of them are gearing up now to release cash on the hopeful assumption, from their point of view, that prices might come off a bit and they get a bargain post SDLT. But what they're all saying, and obviously that reflects in the numbers and the split we're seeing with just as much, an increase in purchase. Actually, though, from a landlord's point of view, the deal works. The deal works. The yields are there. They're not stepping away from it, and they will buy new.
Yeah. Fair points, and there's some really good points there. Is there anything else you want to give advice, give information to our audience while we've got last minute or so?
Okay. I think really it's just keep talking to those that are supporting you in the specialist market. So rely on Dale and Impact for access to intel as to what's going on in the market and where lenders are at. The credit cycle went from beginning of March to a pretty grim place where people didn't really want to lend anything, but then just has come back to a situation where people want to invest in UK and UK buy to let. So I would say confidence will remain, touch wood. And I think what we're also beginning to see now, and it is purely a confidence thing, where funders and lenders will return to 80% lending, even on complex stuff, HMOs, limited company, etc. Because funders and markets are more confident than ever that prices are not going to crash to the floor.
Yeah.
Okay. Back in, who knew?
Yeah.
That's the price.
Some good points. Steve, really appreciate your time. We've run out of time now, so really appreciate you taking the time and efforts to give us a presentation and then to take questions afterwards as well. Thank you for watching. We're doing quite a few of these once a week now at the moment. Every Wednesday, we'll be having half an hour with a specialist lender like Fleet Mortgages. In the meantime, if you have any complex inquiries, you have any buy-to-let HMOs that you're struggling with, give us a call. Obviously, we're one of the preferred partners with Fleet. We have other lenders on our panel as well. And as part of Impact, we will help your clients. So thanks again for watching. Stay safe and keep well.